a huge favor, and if you can hear me right now, give me a thumbs up or something in the comments there so I can see that you guys can hear me. Can everyone hear me? Audio's good? Awesome, awesome, awesome. I just want to check this. Oh, no, I put it on mute. Okay, we'll go ahead and leave that. So a couple announcements. First of all, if you guys want to ask a specific question to make sure I see it, just do a super chat. And I've got Sebastian that's looking at those, and he'll text them to me so I can answer them and make sure that I get to them before we leave the live stream. And tonight, I'm going to mix it up a little bit. I had a couple suggestions from some viewers that I thought were really good ideas. Instead of trying to go back and read the old questions, I'm just going to go to, as soon as I get done doing a super chat question, I'll go ahead and look at the questions as they're coming up on the screen and see if that kind of moves things along a little bit faster. Also, I wanted to say I did that interview with Jason Hartman, who's the real estate professional. He is the host of the podcast, The Creating Wealth Show, which is, I think, probably the #1 podcast in all of the United States for real estate investing. I wanted to upload that Friday, but we didn't have a chance to edit it. So most likely you guys will see that tomorrow. So stay tuned for that. Okay, let's cruise into the questions. Sebastian says that he can hear me, so that's good. Let's see. Okay, I'll go straight to the first one that I see here. Question. Oh yeah, and make sure, guys, you put question and you put it in all capital letters so I can see that. I know that's not just a comment. I hear talk of the U.S. So Scott R says, I hear talk of the U.S. dollar crash, but won't other reserve banks just devalue their currencies to match? It depends on how fast the U.S. dollar crashes. At a certain point, you don't want your currency to go down too much. The reason a exporter would want their currency to go down, because in their minds it makes their goods and services more competitive, but you don't want your currency to inflate away to nothing. As an example, with Venezuela, their currency turned to toilet paper, and that's not doing them any good, even the exports. Okay, I see my buddy Suicide Van here. Hey, George, does Colombia have central bank? Yes, it does. If so, why are there no housing asset bubbles there? Well, first and foremost, because they're not the reserve currency, so they can't artificially lower interest rates. If they lower interest rates too low, they get inflation. They've got to jack those rates ASAP. And they're only, last time I checked, about 50% debt to GDP. So they've got a lot of wiggle room in their rates. But because there's no artificially low rates and there's very low credit in the system, the mortgage rates here are probably 12, 14%. And very few people actually have mortgages because the rates are so high, and real estate assets here are seen more as a savings account. People here don't trust the banks, and they don't trust the governments with their currency as far as maintaining that purchasing power. So you'll notice in the East, they trust gold a lot more. That's how they maintain their purchasing power. That's where they put their wealth. In South America, it's all about real estate. Okay, let's see here. Moving on. Let's see. Question, guys. Okay, question. Nathan Jones. Seems like the jobs report is the last beacon of hope from the American economic news. Is this number rigged? What's the real unemployment rate in the United States? I know that it's a lot like inflation. If you go to shadow stats, you'll see that they jerry rig it to make it look better than it seems. And most people don't talk about the labor force participation. So if you include that and you adjust it for the way it was measured decades ago, it's a lot uglier than that headline number looks now. Also, too, I heard Schiff say something that was really interesting, that the people who went on strike with GM, when they came back, I guess they came back to work last week, that actually showed up in the jobs numbers as additional jobs, even though they're just going back to the jobs that they already had. The way the numbers measured, that kind of juiced it a little bit. And that was probably 50,000 workers. So listen to Schiff's last podcast, or his second to last podcast, and he really breaks it down a heck of a lot better than I can, but it was a decent number, but it wasn't like a blowout. I think he said Jim Cramer said that was the best jobs number that he had ever seen in his career. It's just, okay, whatever. But keep in mind that the jobs number is always a lagging indicator. It's always going up as we're going into recession. Okay, Kevin Belcher, thank you for the super chat, buddy. He says, George, are you concerned at all about rent control? Yeah, I absolutely am, Kevin. Rent control is a disaster. That's one thing that all economists agree on, whether it's Krugman, Friedman, Thomas Sowell. It just doesn't matter. They all agree that rent control is a bad idea because it's a price control. And when you artificially manipulate prices, you get a supply shock, meaning that the supply goes down. So there will be people who benefit. Don't get me wrong. It's always a cost-benefit analysis. There will be people that benefit as a result of rent control. But on net balance, if you go and look at history, you'll see that it's not a good thing. Another example that people don't really think about is look at New York City right now. They diverted all those resources into building these super high-end condominiums that now have been sitting on the market for the last 5 years. And people are now borrowing money just to keep up with the carrying costs, property taxes, maintenance, etc., because they don't want to sell them now because they'll take a huge loss. So they're borrowing money to maintain the carrying costs in hopes that the market still goes up. Why are they doing that? That's because rent control. If that wasn't in place, all those resources, not all of them, but a good majority of them would have been diverted into lower income housing. But it wasn't because no investor wants to do that because they don't want to mess with rent control. So, all right. Lisa Smith. Wow, Lisa, thank you very much, Lisa Smith. That's very, very generous of you. I really appreciate that. The question is, why does Jim Rickards only recommend holding 10% of your assets in gold? If he thinks it's going to 10 to 50 an ounce, 10,000 to 50,000 an ounce, why shouldn't you have more in gold as a way to preserve wealth? You're a rock star teacher. Thanks for all your efforts. Thank you, Lisa. Thank you for the kind words as well. This is a fantastic question, and I've gotten it a lot. And I don't recommend doing anything over 10% either. And I just did a video saying that gold could go to 100,000. Why is that? Because there are no certainties in life, especially when you're dealing with a complex system like the economy. It's just like the weather. You can try to look at probabilities, but you'll never get it 100% right. So, and then you can never get the timing right. Does gold go to 50,000 an ounce in a year? Probably not. 10 years? It's more probable. So if you had that money, let's say you got $100,000 and you put it all into gold where you have negative carry, meaning of carrying costs. If you would have taken 90,000 of that and put it into a cash flowing rental property, and even just let's say you bought it outright and you're getting $1,000 a month in rent, let's just say that was your net to keep the example easy, you'd be collecting $12,000 a year. Over 10 years, you'd have 120,000 additional dollars that you could buy more gold with. So it's not that I don't like gold. It's not that I don't think gold will go up. It's that there's an opportunity cost if it doesn't go up for 10 years or 15 years or whatever. And although you can say pretty certainly that gold will be higher in the future, you don't know when. Again, it's just like the weather. It's such a complex system. There's so many variables that even the smartest guys out there, like Bass and Gunlock and Rickards, they can only say it's going to happen. They just can't say when. So hopefully that's answers your question. We got Seamus. Thank you, Seamus. No question. I appreciate the support. And then, oh, you got another one where he's got a question. George, 30-year. See, 30-year Canadian living with, okay, 30-year-old, got it. Canadian living with parents, 1 hour from Toronto, 100K in savings. That's great, man. Congratulations on that, having that savings. No debt. Considering CAD real estate, how do you advise protecting inflation market crash while making money. Seamus, I hate to give you some crazy advice. It's kind of out of the box, but I got to be honest. If it were me, I wouldn't invest in Canada. I don't think the RV ratios are there, and I think your downside is just huge. And if you're right there, that close to the United States, I would suggest just getting a turnkey property in the Midwest or in the South, where you've got way, way, way less downside. You're going to make a lot more cash flow, and it's just, in my opinion, it's a no-brainer. And you can get a good property manager. And if you get a good property manager, there's no problem with that asset being passive. If you don't have a good property manager, then you're going to be in trouble. But you can go through a service like Hartman has, like Jason, and make sure that you watch these videos. I think I talked to Jason for about an hour, and I think I'm going to break it down into 4 separate sections, because he talks about linear markets versus cyclical, using your IRA, 401k. So make sure that you watch all 4 of those videos before you make a decision. That would be my best advice, without knowing the Canadian market locations specifically. And when I say I'd be hesitant to invest in Canada, I'm meaning like urban areas. Maybe you can go out into a rural area or a more suburban area where the price to income ratio is a little more sane and the rent to value ratio is a lot better. And I'm just assuming that it's not based on the numbers that I see from the major cities. Okay, we've got Glennis. Thank you, Glennis. One day, can you please do a whiteboard explanation on derivatives? Yeah, if I could understand them, I'd do a whiteboard. Derivatives are really, really, not only they're esoteric, they're extremely complex, and there's just not a lot of good information out there on how they work, because a lot of them work in the shadow banking system that I was talking about the other day on the video I did with, what was it? No, I can't remember. It was the one where I talked about Jeff Snyder and his view on the Eurodollar market. He's the expert. But it's shadow banking, a lot of it. So I could do my best, but I think there would still be quite a few gaps that I just couldn't explain because the information just doesn't exist. But I'll do my best to try to piece something together that would actually add value. Okay, Free Thinker. Thank you, Free Thinker. We love the name, by the way. What policy indicates inflation is likelier than deflation? Negative rates, balance sheet over 8 trillion, trillions in helicopter money. Yes, once they start doing helicopter money, meaning they get money into the system, and let me be careful here how I phrase this because I want to be really clear. With quantitative easing, that is a way to increase the money supply in the real economy, but you're doing it through financial institutions and their deposits with the banking system. And if this doesn't make sense, don't worry about it, guys. I'm actually going to come out with a video on this week for sure, probably Tuesday. But the money goes from the Fed to, let's say, a pension fund, and then that money goes into the banking system as a deposit for that pension fund. So it doesn't necessarily get into the people that are going to spend it to increase that velocity. Once you start seeing something like a UBI, especially like Yang's UBI, because that's, I don't want to go into it, but that's nothing like Friedman's. That's going to increase, not only going to increase prices just through the VAT, but it's also going to increase prices through increasing the velocity. So that's something, as far as a catalyst, that I would definitely look for to see that inflation is kind of moving up the ladder as far as probabilities. Let's see, negative rates. Negative rates, Yeah, but see, again, it depends, because just because rates are negative, it doesn't mean that it's going to increase velocity. And it could actually decrease velocity, because savings could actually go up in a certain situation, because savers who are expecting a 2% return to retire, now they're getting a negative 0.5% return. Well, they can't spend as much money. So it actually decreases the velocity. So I think the main takeaway is you've got to look at when the government, through the Federal Reserve or whatever mechanism, starts getting money directly into the hands of the people who are going to immediately spend it and increase that, not only the money supply, but the velocity. Okay, Greg, thank you, Greg. Got a question here. George, I am not convinced the Fed can keep this charade going for years, just like Japan. Nor am I, Greg. I think that's an astute observation. Can you elaborate on why they can't continue down this road? Central bank balance sheets around the world continue to expand, permanent repo, etc. Probably the biggest reason, Greg, is because Japan is the biggest creditor nation in the world. The United States is the biggest debtor nation in the world. So let me give you some specific numbers that might help that make more sense. The average savings rate in Japan with just everyday people is 30%. 30. The average saving rate in the United States, they say it's 8, but I've looked into how they measure that, and that's completely bogus. It's more like 3, and that's being optimistic. So you've got this huge difference in the savings rate between the general population. Why does that matter? Because if the Japanese are saving 30% of their income, they can take more of that income to absorb all of the, I want to say bonds, but it's really all the shenanigans of the central bank and all their money printing, and the government issuing so many of those bonds, and the central bank just monetizing them. So initially it was with the savings rate, because the local population could absorb those bonds. Now, if those bonds would have been purchased by people outside or entities outside of Japan, they would have said, no way, I'm not dealing with this. We're going to charge, we need a higher interest rate in order to keep lending you money. But since they internally were able to borrow and lend at the same time, it makes it so they can play that game a lot longer. But now they can't even play that game, because the central bank owns almost all the Japanese debt. The debt market in Japan barely trades. It really is nuts. And so the reason they didn't experience all this hyperinflation is because the way they did quantitative easing is different than the way we did it in the United States. And that would take me the whole hour and a half to explain to you, but I'm going to do another video on that. So hopefully I was able to explain that. It's kind of hard to explain, especially without a whiteboard. But the bottom line is because their savings rate is so much higher, and because they did QE a lot differently than we did, so they didn't get that money into the hands of the people that are going to spend it, again, increasing the not only the velocity, but the money supply in the actual real economy. But okay, and one other thing I want to say there is Greg, that doesn't mean that there's a 0% probability that the U.S. does turn into Japan. That we definitely could. It's just the likelihood of us doing the Japan thing for the next 30 years and having a huge crash and a lost decade and all those things, it's a lot less likely than it was in Japan. I want to make sure I'm clear there. So Jim, thank you, Jim. We've got, hi, I have 100K in metals. Okay, house prices are overinflated in no kidding. New Zealand is one of the biggest bubbles in housing right now in the world. Also, our longest term is 5 years, so could get stuck with inflation, gets traction. Okay. Am I best to keep it where it is in metals? I don't think so, Jim. Normally I'd say put it in real estate, but it's just you're damned if you do, damned if you don't, because you want to get that cash flow. I would explore companies maybe like Sprott that would be a play on gold, but maybe also would pay you a small dividend yield. So at least you're getting paid to take a bet on gold. And that's more speculative. I don't really consider that an investment. Maybe you could look into the United States and do the same type of thing. I know a lot of rental properties in Kansas City were being, when I was there doing it hands-on, were being purchased by investors in Australia. And so it's definitely doable. I might look into that. Or maybe another market that you know of that maybe you're even more comfortable with, where the prices just aren't insane and you've got so much downside risk. That's probably the best advice that I can give to you. And I apologize, guys, that I can't give you better advice on this. But the problem is because these central banks have artificially kept interest rates so low for so long, it just creates asset bubbles in everything to where there's just nowhere to hide. You can't put your money in cash because you're worried about inflation. You can't put your money in a house because it's a housing bubble. You can't put your money in stocks because that's a bubble. You can't put your money in bonds because that's a bubble. It just, there's nowhere to hide. So that's the best advice that I can give you. Other than trucks, do you guys have any Ford trucks there? If you guys have 1995 to 2002 Ford trucks, Jim, take a look at that, the 7.3 power strokes. All right, Linda asks, do you see home prices coming down as baby boomers retire with fewer millennials being able to afford these inflated prices? And I would add, because of their student debt. Linda, I see home prices coming down in the United States as an average across, especially in these really high-flying cyclical markets like Los Angeles, Seattle, San Francisco, for a variety of reasons, not just demographic reasons that you're talking about. Additionally, I would add, looking at a long-term chart of U.S. housing, you see that there's a historic trend line, a very distinct historic trend line when you adjust for inflation. Why is that? Because housing prices typically stay consistent with wages, and wages typically stay consistent with inflation. So when you have a huge discrepancy between that historic trend line, and that goes back to 1890, when you're way up here, it's going to mean revert. It's just a matter of time. That doesn't mean that nominally prices would go down. We could have a situation where nominal prices of homes actually go up, but you lose purchasing power because they don't go up at the same rate of inflation due to demographics or due to a variety of other things that could make the housing market fall apart. I'd also like to remind people that just because we have an inflation doesn't necessarily mean that housing prices will go up. A lot of people don't think about it, but when we had the housing crash in 2009 to basically 2012, we didn't have deflation. Look at the CPI. The CPI, which understates inflation, was positive the whole time, but yet housing prices fell by 50%. So and why is that? Because there's so much credit in the system that you can have a credit bust while still having, or a credit bust that leads to an asset price crash, while at the same time the CPI or the things that you're buying at the grocery store or your healthcare actually increase in price. So long story short, I lost the question. Here we go. Long story short, I lost your question. Sorry about that. Long story short is I see housing prices in the United States mean reverting as a total. And again, real estate is very local. So there are markets that I think have a lot less downside, which I've mentioned in the past. Want to make sure that's clear. Okay, Free Thinker, thank you again. Won't a dollar collapse lead to a fall of the US due to lower military welfare spending, race riots? Will your Midwest properties survive this? I think the Midwest properties will have a lot better chance of surviving that than everything else, because I'm buying them in really good neighborhoods. Now, if I was buying them in the ghetto, that might be a different story. But so if you're buying a house that's $150,000 and that happens, people are still going to need somewhere to live. So you might have people that before could have afforded a $300,000 house, and now they can afford your house. But it doesn't make all the home buyers or the renters, in that case, just completely disappear. We could have a situation where that you do lose purchasing power on those assets. But if you got 10% in gold, if we get to a point where you're losing money on your rental properties because things just deteriorate and get so bad, the chances are that you would make up that purchasing power with the gold side of your portfolio going up. So that would be the best way I can answer that question. We got Conrad. Okay, Conrad, thanks for the super chat. Gold-backed crypto bank, good idea in USA, doable. I'm not sure if it's doable because I don't know the rules and regulation regarding the banking system, but I think it would be awesome. I mean, a gold-backed crypto, what's not to like about that? You're combining the best of both worlds. You've got the history of gold and the store of value, while at the same time the transactional ease of a cryptocurrency. I love the idea, but I'm not sure that it's doable because I don't understand the plumbing of the regulatory hurdle that you'd have to go over to make that happen. Especially in the United States, it would probably be easier for non-US citizens in a bank that was located outside of the US jurisdiction. Hey, Chris, thanks, Chris. The last couple economic crashes, the price of silver and gold have all dropped with the market. Is this time different? Why not wait to buy? Gold is interesting in the sense that it's not always inflation that drives it. It's not always a market crash that drives it. It's usually a response to that market crash, or it's kind of an inverse, it has this inverse relationship with the confidence that people have in the system itself. So I'm not saying that gold won't go down, because it very well could, especially if people like Jeff Snyder and Brent Johnson and Jim Rogers are correct about the dollar going up first and then crashing. That would be very bearish for gold. The reason I wouldn't wait to buy now is because you don't know, we could get a inflationary recession or an inflationary depression where gold just goes to the moon, and you can't, it's too late. You can't get on that ride. I probably wouldn't take a full position right now, but I would set up a core position. So whichever way it goes, you're still good. You're maintaining your purchasing power. And then if it does go down, you've got some dry powder to take advantage of that. I think that's what most of the pros would tell you as well. Okay, back to the questions. I'm gonna see what's going on in the chat. Guys, you have a question, make sure you write it in capital letters. Question, a lot of saving. Question, how do I know, Patrick says, how do I know if real estate in my country is in a bubble? Real estate in the cities reached 2008 price. On the capital, it's still 30% lower at all time. Talk about Romania. I've heard a lot of great things about Romania, Patrick. I know Andrew Henderson with the Nomad Capitalist does a lot of homework on those markets in that area. You first and foremost have to start with the cash flow, because that's in essence what you're buying. You're buying a stream of cash flow. So if you can get a property, it's in a great neighborhood that's really desirable, and you can get a 1.5% RV ratio, that's, especially in an interest rate environment where they're so low and the yield on almost everything is non-existent. A 1 or 2, so let me say that a different way. A 1 to 1.5 RV ratio will give you around a 10 or 12% net return, assuming that you use all cash and you don't leverage it. So that type of return in this environment, I think that in and of itself makes it cheap and a good deal. And since you're buying the cash flow, you don't really care if the asset goes up or down, or especially when the price to income ratio there, I would assume, would be within the realm of sanity. And the reason I don't say that about Canada is because, number one, you got way more downside, but number two, you can't get good RV ratios, so you can't get cheap cash flow. So you got to hang on to that asset. Even if you can afford the payments, you still have a huge opportunity cost. And if the RV ratio is lower than 1%, then there's a good chance that you're going to have a negative carrying cost. And if you don't have appreciation to offset that, then you got big problems. Okay, question, ultimate bargains. Will shadow bank cause severe, dang it, I lost the question. It was, they're moving so fast. Okay, I think it was, will the shadow banking system cause massive deflation? It's a very hard question because you just don't know what's going on. I would suggest everyone listen to a podcast on the Bob Murphy Show podcast. He has an episode that's a couple months old where he interviews Jeff Snyder, and they get into the weeds about the repo market, also the shadow banking system. And Jeff Snyder is probably the premier professional or the premier expert on the Eurodollar system and shadow banking in the world. And even he'll admit that he doesn't, it's just not, it's unknowable to know the size, to know to the extent at which banks are lending to each other in dollars or yen or euros outside of the jurisdiction of those sovereign nations that issue that currency. And he said even he can only guess as to what may happen. So it's really hard to give you a specific answer or even outline probabilities. I can tell you that it won't end well. I know that. Does it not end well with a massive deflationary bust or a huge inflation of the reserve currencies that we have, which would be the yen, the euro, the dollar? I'm not sure. I'm not sure. It just doesn't end well, because you've got the normal economy that produces goods and services is this big, and the financial economy now is just, who knows, 100 times bigger, and that's unsustainable. Okay, Conrad asks, any gold, silver, mining stocks that you like right now? No, because I haven't been able to research them as much as I would like to, because in my personal portfolio, that the speculative, the allocation that I have to speculate, which is what I would consider the miners, I kind of leave that's last on my list of priorities to research. So I haven't got there yet, but I know a lot of people are asking about it, and I want to know about it for myself. So if I get some time this week, I'll definitely look into it. Mandy Me. No question, just a donation. Thank you very much, Mandy Me, or Manda May. Hopefully I'm pronouncing that right. Thank you very much. I appreciate that. Okay, going back to the questions here in the chat. A question, do you have a stock portfolio? If so, can you talk about it or make a video on it. Rich. Right now, I've got a small stock portfolio. It's nothing much. I own no U.S. stocks, just in some foreign countries and some, I wouldn't even call them emerging markets. I'd say more some crisis markets or some frontier investments. But the majority of my assets are in real estate right now. That could change, and I want that to change. And I'm going to explore more dividend opportunities in foreign countries where you can still get really good cash flow from a stock, because I realize that for most people that are based in the United States, that's a lot more realistic to buy an investment that's going to pay you to own it than buying a piece of real estate in Medellin, Colombia. So I'll be researching that for myself first and foremost. And all the information that I find, I will be doing videos on that or sharing that with all of you guys. Okay, next question. Okay, Blake, how to take advantage, oh man, they're moving so fast. How to take advantage of, how to take advantage of 2008 housing bubble popping. I'm assuming you mean that if it pops again. If you want to keep some powder dry, I mean, that's a great use for gold right there. Because the problem is when it crashes, it's usually crashing because the credit market is freezing, and therefore it's really hard to get a loan to take advantage of that 30-year mortgage, assuming that they're still really cheap. And then you got to ask yourself, well, do you keep your money in cash? Because then you run the risk of inflation. That's, if I was going to keep powder dry specifically for that, I would, and I only wanted to invest in USD assets. Believe it or not, I'd probably do short-term treasuries. I know that sounds crazy for a guy like me to say, but just maybe 3 months, 6 months, something like that. Just keep rolling them over. So if inflation does go up, hopefully the Fed would raise interest rates so that those T-bills that you keep rolling over would get a higher rate of return so that you wouldn't lose as much purchasing power with that cash, but it's still super liquid. So if you see an opportunity in the real estate market, you can take advantage of it. I mean, that's what guys like Buffett do. I know Simon Black with Sovereign Man is a really, really smart guy. He does that, and he's just as suspicious, let's say, of the U.S. economy as I am. And that's the way he keeps his liquidity and his powder dry. All right. Question, how old are you, and will the Fed decrease interest rates on Wednesday? Oh man, I got to think of a different way to do this now, because now the questions move so fast I can't read them. How old am I? 46 years old. That's easy to answer. Will the Fed lower interest rates? I don't think so, because the market's at all-time highs. Unless Jerome Powell knows something about, unless the repo market has spooked Powell. If the repo market spooked him and he's found religion when it comes to the euro dollar, and he's taken the advice of Jeff Snyder, and he starts to understand that there's a dollar squeeze, or there's a lack of dollar, there's a lack of dollars in the system outside of the United States, and that's a big problem. Assuming Jeff Snyder's right, then the Fed would need to drop interest rates and just make up some excuse why the economy is still amazing, but yet they're lowering interest rates and doing QE4. But my guess is that they haven't found religion. They still don't understand that like Snyder does, and they just see the stock market being high, so they just want to hit the pause button and do nothing. Okay, question. Let's see. I have a lot of, oh, dang it, these things are moving so fast now I can't read them. Sorry, guys. Next week, Sebastian and I will figure out a better system here. let me try to. Okay, question on the euro, your yen video. What can stop banks with no reserve requirements from continuing to do the derivative game? The Fed continues scooping up assets on the balance sheet the Fed continues scooping up assets on balance sheet in the US forever. What stops that game? I'm not sure. And that's actually something that I've really been thinking about this weekend, because if Snyder's right and they don't have any reserve requirements, they can just create this money as they see fit and lend it to whomever they see fit, and sometimes maybe even creating a loan to go through another entity to come right back and lend to themselves and like bail themselves out just by creating dollars. I don't understand how that reconciles with Snyder's opinion that we have a dollar shortage outside of the United States, because if the euro dollar system can create these dollars with no restrictions whatsoever, why is that market having liquidity issues when it comes to dollars? So I've tried to research that this weekend, and it's so, there's so little information on it. It's hard to put the pieces of the puzzle together, but I can promise you that I'm trying my hardest to do so, because I'm fascinated by it. And as soon as I figure that out, I'm immediately going to do a video on it. That I can assure you. Okay, going back to the super chats. Violin, thank you very much for the super chat. Really appreciate it. No question. So going back, my goodness, these questions are going fast. Okay, let me try to stop this here real quick just so I can see one. Okay, let's go to Jared asks, will repo market have greatest probability to trigger this avalanche, do you think? And now I lost the question. Well, let's go with that. Will the repo market, I'm assuming, Jared, when you're talking about the repo market creating this crash, you're talking about the financial crisis. And I don't know that it would create a financial crisis. Now, if the Fed wouldn't have stepped in with this massive injection of liquidity and brought the rates from 10%, which they naturally spiked to, down to where they wanted them, around 2%, then yeah, it probably, I mean, you would have a massive liquidity crisis. And that would have had some really, really bad side effects. But I think that the repo market, or what's happening in the repo market, is a symptom of something else. And therefore that something else has a better chance of being the catalyst to the next financial crisis than the repo market itself. I always go back to the corporate bond market, and I don't know if there's a connection of the corporate bond market and the repo market. I'd have to analyze that a little bit further, but just when you look at the amount of corporate debt that's out there, that's just one notch above junk, and you know that they've used all that debt to buy their shares back, and therefore if the market goes down by a certain percentage, they're going to get downgraded, and that debt is going to get downgraded into a market that just cannot absorb it. That's the biggest risk I see to the current economic, I don't want to call it conditions we have, because I don't want to say that right now the economy is great, because quite frankly, I think right now the economy is in recession. But that would be in my opinion, that's the biggest catalyst. That's the biggest concern that I have. That's the biggest risk to the way the economy is right now. Okay. Lewis, thank you, Lewis. I recently moved to North America and have a pension benefit with my company. Okay, what would you recommend as a portfolio? I'm 31 years old. Just what I like to do, Lewis, is I like to buy things that are cheap, sell them when they're expensive. I like to own things that pay me, and I like to have diversification with insurance, political risk, and currency risk. So I'm not sure how much you're dealing with, but I would say own some gold for sure, physical. I would say if you can, get a nice solid rental property in the Midwest or the South. The ones that I always, or the type of markets that I suggest, the linear markets in a good neighborhood. And if you can do that using 30-year fixed rate mortgage, I think you're off to a great start. That's what I'd suggest. Okay, CA, no question. Thank you, CA. George, only comment is that the quality of your YouTube videos are excellent. Thank you very much, CA. We're really working to improve them. Just so you guys know, what we're trying to do is we're trying to set up the area where we shoot to mimic a guy that's on YouTube. And what is his YouTube channel? It's Engineering Explained. So if you guys want to see what we're shooting for and what we're trying to figure out how he does that lighting, because his whiteboard videos are just awesome. So, I mean, he's a genius, number one, but the clarity of the markers, and it's just spot on, and it's all about lighting, but it's very technical and it's hard to do that. So we're striving to get there, and that's what our objective is. We'll get there soon, but we're just not there now. And I'm always trying to get better. I mean, I go through these videos after I upload them and I see mistakes that I make or words that I stumble over, and I'm just like, oh, George, you look like an idiot. But thanks for bearing with me. I always say thank you for bearing with us, not just me, but our whole team, because we're trying to learn this. We're very, very new to YouTube, and we're still going through a lot of YouTube growing pains. And I can assure you that we're working hard to improve, and it's only going to get better from here. Brent, George, when commercials on TV are pimping gold to retail investors, the contrary says it's time to sell. Thoughts? I would 1,000,000% agree. Brent, I think you're spot on. I love gold, and I even the asset classes that I like. When everyone gets to one side of the boat, you want to be on the other side. And once you start hearing your Uber driver talk about buying gold at the local mall kiosk, or for that matter, buying real estate or buying Bitcoin even, and even if you're a long-term bull of Bitcoin, you know it's not going straight up. It's just like a stock. It can be overbought and it can be oversold. And even if gold's going to 10, 50, 100,000 an ounce, it's not going to go there in a straight line. That's not how markets work. In fact, Jim Rogers is notorious. He's probably the most well-known commodities investor, but he might be the best in recent history. I mean, he's really, really good. But he always says that when commodities go on a big bull run, they almost always have a retracement of at least 50% before they start going back up. That's why if you watch Rogers' videos, he was, especially his videos maybe 3-4 years ago, when gold went up to 2,000, he was saying that he expects it to go down to 1,000 and then go back up because of that history that he's seen with most of his commodity investments through his career dating back to the 1960s. So again, Brent, to answer your question, yes, I would be concerned. I might not sell my gold, but I would definitely not buy any when you see those commercials pimping gold to the retail investor. Okay, question. Here, let me try to stop one. Okay, Fernando asks, since you're in Colombia now, what do you think of Brazilian market? I'm not sure. Fernando, because I have not studied Brazil, to be honest with you. So I can't give you a good question or a good answer on that. My guess is I'd like it better than the United States market, especially the stock market. But I don't know. I'd have to see if it's cheap. I'd have to see. I'd start with the CAPE ratio. I'm assuming you're talking about stocks. I'd start with the CAPE ratio. I'd look at the CAPE ratio to see where it is relative to where it's been historically. And if it's cheap, I'd consider put my big toe in the water as long as you're good at that fundamental analysis and the macro analysis and you know what you're doing. I'm not sure that I'd buy the whole market because I doubt you'd be getting a very good dividend yield. Okay, got that. Let me go to the okay, question. I have a lot of savings in my bank and I live in the US. Is it a good idea to move my money to India, considering the high rate of interest, GDP growth, and imminent collapse of the United States dollar? I wouldn't move all my money anywhere, no matter how bullish I was on a specific country or a market. It goes against my third rule, and that's you got to diversify. So, especially if you live in the United States, you definitely want to keep some dollar-denominated assets that are producing cash flow because all your bills are denominated in US dollars. And you can imagine what would happen if you took all of your assets and moved them over to India and your bills are denominated in dollars. And let's say the dollar goes up to 120 on the DXY. Now you got problems. You got big, big problems because now you're not able to pay your bills with that cash flow because the value of that cash flow has decreased relative to the currency in which your bills are not denominated in. So that's not to say that I wouldn't take some chips off the table in the United States and move them into a different country, set up a bank account, buy some stocks that are denominated in the rupee. Maybe, I don't know if you could buy, I don't know how well you know that, but maybe you could buy some real estate in India. But I definitely wouldn't move 100% of it. And I don't think I would move, if I was living in the United States, I don't think I would move more than 40% would be my max, again, because I'd be so concerned about my currency risk because my bills are denominated in dollars. Okay, Mike Sutherland asks, curious about the used diesel trucks. Do you see them appreciating value? Absolutely, I do, Mike. I sure do. But let me be clear. One of the great things about used diesel trucks, and not all of them, most of them are garbage, but you've got specific models like the Fords between 1995 and 2002. They came with a very specific motor. It was a 7.3 Power Stroke diesel. Even the 460 gas, even those are still, I wouldn't call them collectible, but they're in very high demand. And Dodge had the Cummins. The 12-valve Cummins was, for truck guys, that was probably the best motor ever made. So nowadays trucks are $60, $70, $80,000, and it costs you $1,000 just to change the oil. But those old Fords and Dodge Cummins, those were very easy to work on. And if you can get them with under 100,000 miles and just park them in your garage, you're not gonna lose money on those. I can promise you that. But you have to buy them correctly. It's just like real estate. And what's neat about the truck market is that it's extremely inefficient. So you've got the most efficient market being like the FX market, or gold is very efficient. You can't get a spread there. Real estate is less efficient, but in the United States, it's still a lot more efficient than it is overseas. But buying these trucks, I mean, I can, as an example, I used to buy trucks in California when I was in the States helping out my younger brother for a year. And I would go there and buy 460s because gas prices in California are what, $5? And these 460s literally get like 8 miles to the gallon. So you'd have all these old timers that would have these 460s that they'd never drive, that they just kept in their garage, that had 90,000 miles on them and are in pristine condition, no rust at all. And they can't sell them because no one's going to fly in from Detroit or from New York or Ohio, a state with a lot of rust, and buy this truck because just no one's going to do that. So what I would do, I'd go out there, inspect it. I had a system for doing it, but then I'd go grab the truck, I'd clean it up, and I'd do pictures. I put it on eBay, and I'm not kidding you. I've purchased trucks in California for $7,000, and 2 weeks later, put the exact same truck, exact same. All I did is clean it up and have it detailed. I put it on eBay and sold it for $14,000. Just boom, just like that. Because you're buying something at a hyper local level where there's very few buyers, if any at all, and you're selling it at a national level where there's a tremendous amount of buyers, and that's where you pocket that spread. So you can make good money doing it, but also if you would have just taken that truck and parked it in your garage until you needed the liquidity in 5-10 years, you're going to be, I personally think you're going to be able to sell it for a lot more, not just in nominal dollars, but in real terms, because they just don't make those anymore. They're never, ever, ever going to make another 7.3 diesel, and by Power Stroke, the International. So you got these old timers and young kids too that know how good that motor is, the real hardcore truck guys, and they're always going to be in high demand. They're almost like a collector edition type thing. So Free Thinker asks, is silver separate from the 10% gold allocation? Yeah, because I consider silver a little more of a speculation right now because it's an industrial metal. And with the market at all-time highs, if the market goes down, that could take silver along with it. And I think that's why the silver gold ratio right now there's such a big gap in it. Okay, Chris asks, debating between silver and gold, pros and cons. I kind of just went over them, Chris. I think that the upside to silver is that spread is high relative to where it normally is historically. But I think the con is you've got more downside because the market's obviously in a bubble and at all-time highs. Okay, MPGXSVCD, one of my buddies in the comment section. I don't know how to pronounce the name. I'll just say miles per gallon, MPG. That ought to go with the truck theme for tonight. I can help you with the whiteboard camera setup. Great. Thank you. Thank you. I do camera reviews on my channel. The trick is getting the camera and settings right. Just message me. Sebastian, I know you're watching, buddy. Can you please somehow reach out to MPG and get maybe his email address so we can do that first thing in the morning? Thank you. Okay, going back here, guys. Let me try to go to the most recent question, like I've had some viewers suggest. Okay, there we go. Okay, make sure, guys, if you got a question, make sure you start with question in capital letters, please. Okay. Katie. Okay, got that, Sebastian. And Katie, I just saw you in the chat here. So, or Caddy, excuse me. Caddy says, and thank you for the super chat, Caddy. George, I want to know, how is the U.S. debt clock has a different price for gold, silver per ounce? Please explain. I want to know how is the debt clock. I'm not sure exactly what your question is, Caddy. Can you do me a favor? And when we get done with the live stream, if you're on Twitter, can you DM me on Twitter so you can explain this, so I can understand a little further, so I can understand it better, so I can give you a more precise answer. And if you're not on Twitter, go ahead and just shoot me an email. My email address is on the About Us, or the About tab on the homepage of the YouTube channel. So I'm not sure exactly what you're asking there. Okay, Milan did a super chat. Thank you, Milan. I appreciate that. Okay. Here's a question. Oh, I just had, that was a great question too. That just, let me try to go back to that. Okay, Steven asks, what about the econ folks saying that millennials are now reaching the age where they start spending the most and will inherit 7 trillion from the boomers as they pass, made GDP grow? So these are people that are looking exclusively at demographics. And I think demographics are great. And I think they really drive the economy in most situations. But I don't think it really applies, or I don't think it applies nearly as much to millennials, because they've got so much student debt. And you can't get rid of that in a bankruptcy. That said, we could have Bernie Sanders elected to president, and he could just say, boom, done, it's gone. And that would change the equation. That would change my opinion dramatically. But assuming that they still have this student loan debt where they've got a $300 or $400, $500 a month payment, and you're only making 40, 50 grand, how do you save money to buy a house? How do you, what money do you have to spend? It's all going to pay off that student loan. So I don't think that we've got as much tailwind with the millennials or the echo boom as most economists would lead you to believe. Okay, Bollinger asks, hi, George, can you break down your portfolio? For example, 10% real estate. My personal portfolio right now would be, it's going to be 90% real estate, excluding cash. I don't really consider that my portfolio, because I keep a substantial amount of cash there in case a real estate deal pops up, I can grab it. But as far as what I've got invested, it's going to be mostly real estate, a little bit of gold, and a little bit of foreign stocks. I'd like to keep some powder dry for speculations like buying the juniors, but right now I haven't been able to do so just because I haven't had any time to do the research. So, but the takeaway, please, I think hopefully everyone, hopefully that sinks in with everybody. And my message there is that you'll notice that I practice exactly what I preach. And I want everyone on the live stream to know that every single thing that I suggest doing, whether it's the rental properties or the trucks or whatever, I'm not only doing myself, but I tell my own family members to do that. My own sister, my own mother. I tell them to do the exact same things that I do myself, and the exact same things that I tell you guys to do. There's no difference at all. So I can't be any more upfront and honest than that by suggesting what I'm suggesting my own family does. And I've never said that before, and I've never done a video on that. So I think it's really important that everyone realizes that. Not that it's any more impactful, or not that you should go out and do it right away, but just know that I'm doing it from a standpoint of truth, honesty, and integrity, if that makes sense. John, question: if Elizabeth Warren wins and implements her socialist agenda, do you have any plans to escape the onerous capital gains tax? Well, let me say a couple things on this, John. First of all, I'm not in a position where I have 50 million in assets for her to start taxing right now. But I think that the way these taxes work, if we look throughout history, they always start as though they're only going to be applicable to the rich people, the fat cats, the people that don't pay their fair share. But as time goes on, and a lot of times it's not 30, 40 years, especially if you look at the case of the income tax. When that came out in 1913, ironically enough, the same year, Federal Reserve, it started off the exact same way. If you look at the rhetoric, the political rhetoric around the income tax, it's identical to Warren's rhetoric around a wealth tax. I mean, it's verbatim. So what happened? Well, sure enough, in 1913, it started off as a tax just for rich people. And by the next, what was it, 4 or 5 years, we go into World War I, and all of a sudden, nope, not for rich people anymore. Now it's for everybody. And what does that go away when World War I is done? Nope. Nope, stays the same. And the middle class and even the poor in the society to this day still are burdened with some form of income tax, whether it's payroll or whatever. So my point is that it may start with a 50 million threshold, but I would not be surprised in the slightest if that 50 million in 5 years was 500,000. And that sounds like a lot of money, but for a lot of people, especially if you live in California or Seattle or San Francisco, where you actually have a house, you could be middle class, you could be even lower middle class and have 500,000-600,000 in equity in your house, where that wealth tax would apply to you. So that's where I see it going. And do I have any plans to escape? Yes, this is why it's so important for you guys to, and I know it's way outside of the box for most Americans, and I don't expect you guys to take action on this immediately, but I would really suggest starting to kind of think this through. And when I say you've got to diversify your political risk, this is exactly what I'm talking about. And it starts with a bank account, but then maybe it starts with getting a residency. And if you do have some flexibility, why not get a passport? Why not get dual citizenship? I'm in the process of doing it right now. Sebastian and I just went to Bogota to get an investment visa. So I'm not sure if it's 3 years, 5 years, but since I now have that investment visa, I can not only come and go as I please, and I think it's even like for 10 years, I can come and go as I please. So if it hits the fan in the US, I've always got a place to go where I don't have to worry about getting a visa. I don't have to worry about coming and going. Not only that, in 3 years, I'll have a passport where if you want to just tell the US to pound sand, you've got that option. Not that I would do that, and not that I'm suggesting anyone do that, but you've got a plan. You've got options. Options are good. And what's your downside? To me, it just is a no-brainer. And if I've got this extra passport that I can use and have all this additional freedom as a result, that there's only upside in that situation. So, okay, Kurt asks, this has been some fantastic conversations. I appreciate that, Kurt. I'm really trying to improve on the live streams as well, because actually, believe it or not, it's tough to answer these questions right off the top of my head, but I'm trying to really think through them as I go. That's why there's a lot of pauses, because I'm just trying to give you guys the best answers that I can. I hope this stays a weekly thing. Yes, that's what we're planning on doing. This channel is really going to help people. I hope so, Kurt. It's just a win-win for everyone, because I love talking about this stuff. And initially when the channel started, it was more geared toward real estate, because quite frankly, I didn't think anyone would want to hear me rant on about macro. And I just snuck in a couple macro videos just because I just had to get this off my chest. I was like, okay, I'm doing the real estate videos, but this is driving me crazy. I got to do a video on the repo market or whatever it is. And as luck would have it, everyone loved the macro videos, and the real estate videos, they're okay, not that great. So it really worked well that people just so happen to like the videos that I enjoy doing the most. So Bollinger asks, thank you for answering my question. Sure, no problem, Bollinger. Okay, we're going back here. Stephen, I think we got that. So let me go to the bottom. Okay, let me try top. I'm just giving you guys the play-by-play here. Sorry about that. Nathan asks, do you think the stock market is being propped up to show China that the U.S. has strong economy and that would benefit by agreeing to Trump's demands? No. I think that Trump is trying to talk up the market, and maybe for that purpose, Nathan, but at the end of the day, the market is bigger than any politician, any central bank, bigger than the IMF, bigger than anything. The market has the final say. And I don't care if it's Japan, I don't care if it's the Eurozone with 17 trillion in negative yielding debt that's so far so good, doesn't look like it's going to blow up. Sooner or later, it'll be time to pay the fiddler. And the market will have the final say, and there is nothing that any politician can do about it. So I do think that Trump is trying to talk a big game to talk it up. I do think that's probably working to some degree right now, but sooner or later, that's not going to work. Okay, Tim, I see your question, buddy. In the United States, is there a correlation between debt and savings? I'm not sure the exact question you're asking, or I'm sorry, Tom. Is there a correlation between debt and savings? I don't know if you're asking that question from a standpoint of like MMT or Keynesian economics, meaning that savings is just the savings rate lowers the incomes for businesses, and therefore it's not growing the economy like it should. I'm not sure your question there, Tom. I apologize. Maybe you can do another question and kind of give me a little more detail there, and I can answer it here in a couple minutes. Okay, David asks, stop it there. Okay, David Armstrong asks, are you preparing for it hitting the fan beyond finances, prepping food, water, etc.? I don't do that. Hmm, Shoot, I lost the question. I apologize. I don't have your name in front of me now, but I don't do that. And the reason I don't do that is because I don't live in the United States. And that's one of the reasons I choose to spend most of my time in smaller emerging markets because, in my opinion, if it does hit the fan, there's a lot less that can go wrong in a market like this opposed to the United States. Let me give you an example. I was on the coast of Ecuador in this little surfing town called Montanita. This was maybe 3 years ago. And the whole town's maybe 1,000 people. And I remember waking up, it was like 7 o'clock in the morning, go out, get breakfast, doing everything that I would normally do. And I went to go get lunch. This was probably around 1 o'clock. And for whatever reason, I went to order a certain salad or whatever. And the gal says, "Oh, we can't make that right now." And I said, "Well, why not?" And she goes, "Because the electricity's out." Meaning there is no electricity, zero, none in the entire town. And I thought to myself, and I didn't even notice. I literally gone to all the shops and done everything. I forgot what I did that day, but I ran all my errands for the first 4 or 5 hours of the day. And I had no clue that there was no electricity. It didn't stop commerce. It just people went on with their daily lives. It didn't really affect anything. And I thought to myself, what would happen in the United States? What would happen in Phoenix, Arizona, if there was just no electricity, just done for 10 hours? I mean, it would be, I don't know if it'd be chaos to where people would be rioting in the streets, but it wouldn't be good. You'd definitely notice it. So that's my point. I like hanging out in places like Croatia and Montenegro and Colombia and places outside of the United States where I feel like you're a little bit more isolated in a good way. Okay, Paulius asks, thank you, Paulius. How do you calculate Fed total involvement in repo? Is it like overnight? You just add up their balance sheet and you add up the increase in their balance sheet since they started this. And I think they started September 16th. And that tells you how much money that they have committed to, in my opinion, on a permanent basis. But then also, if you go to the New York Fed's website, Paulius, they have all this information. You can just Google New York Fed repurchase agreement, and it'll pop up, and you can kind of do some snooping around there, and you can see what their schedule is for the repos. And then when they change it, they also have like a notification that comes up on the right-hand side, and you can see how much they're buying overnight. And by the way, I think they're buying a lot more than 85 billion right now overnight. The last time I saw, they're doing 300 billion a night. 300 billion. Now that's not just with the overnight desk, but that's with when you combine the overnight commitments that they're making and the term repos, it was at around 300 billion. It adds up to 500. I don't know if it adds up to 500. The increase in the balance sheet might be 500 now, because they're not only doing the repos, but they're buying assets, just basically QE, and keeping it on their balance sheet outside of the repo agreements. Okay. Okay, let me stop. Okay, Spencer asks, is it a bad idea to invest in precious metals through the market, gold, mutual funds, mining stocks, etc.? Investing through a retirement account lets you avoid some taxes on collectibles. Okay, so I'm assuming that you're asking, is it a bad idea to invest in gold outside of the physical, holding it in your hand? My answer to that, Spencer, would be it depends on why you're buying it. If you're buying it as an insurance policy, which is what I think everyone should with a certain core position, then you want physical. That's just, that's the only way that you can own gold where it's not someone else's, where there's no counterparty risk, I think is the best way of putting it. If you own stocks, if you own an ETF, for sure, then your counterparty risk is HSBC. If you're buying the GLD, you don't want that. But unless you've got the physical gold in your hand or in your back pocket, there's counterparty risk. So if there's counterparty risk, is that really an insurance policy? I would say no. If you're looking to speculate, then maybe that's definitely different. Going into the juniors, even maybe a mining ETF. I don't want to go that far because the gold ETFs really scare me. But maybe a mining ETF or maybe if you can really do the research, I think it's best to buy them on an individual basis. But that isn't insurance to me. That's a completely different asset class. To me, that's speculation, just like buying Bitcoin, which I'm not down on Bitcoin, but I just think it's a really good speculation as opposed to really good insurance. That's the same way that I'd look at gold and paper gold. Okay. Caleb. Thank you, Caleb. Asked George, this is great. I'm glad you're enjoying it, Caleb. I love the format and access. Been getting tremendous education from your channel the last couple of weeks. Awesome. Glad to hear it, Caleb. I'm always excited to hear people are getting value from the videos that we're doing. So thank you very much for saying that. Chris, thank you. Chris asks, would sin stocks like weed be a better investment? The problem with weed stocks right now is even if they're a long-term investment, right now, from the little research that I've done, it looks like they're really overbought. And when everyone is buying something, when all of your friends are buying it, when the Uber driver's buying it, I don't like to buy things in that type of situation. Let me give you an example. Last year for Christmas, I gave my niece, who at the time, how was Lex? Probably 25, something like that. I gave her a gift card. But this gift card, it wouldn't get you anything at Best Buy or Target or anything. What it would do is it gave you the ability through like a broker to buy $100 in stock. And I wanted to do that to help them start understanding how investments work. The very first thing that my niece did is bought marijuana stocks. So my point is that although my niece is incredibly intelligent, both my nieces are very talented and gifted individuals, but they don't know a lot about stocks. So if they know about marijuana stocks, that means that they're not exactly unloved. And I always tell people that when you're investing or when you're speculating, especially, you make a lot more money when things go from horrible to bad than you do when things go from good to great. And so I'm always trying to find speculative opportunities when no one wants them. If your buddies think, if you tell your buddies you're making an investment and they say, wow, that's a great idea, I should do that, I hesitate to make that investment. Now, if you make an investment or you're thinking about it and you share that with your buddies and they're like, are you crazy? That's the stupidest thing I have ever heard. No one in their right mind would do that. you're probably onto something. So that's how I do things. Hence why I'm buying real estate in Medellin, Colombia. Try that one on your friends. Tell them, you know what? I got an idea. I'm going to go buy a rental property in Medellin, California, and see what they say. And then you'll get what I'm talking about. Okay, just looking for a question here, guys. Oh, Spencer asks Spencer asks, if you only had a few $1,000s, what would you speculate on? Pure speculation? I'd try to spread it around a little bit so I could have some diversification, but miners for sure. Miners, maybe uranium. Maybe some commodities like sugar and Bitcoin. That's probably where I'd start. Okay. Try to go to the most recent question. Okay, Tom, I think he's restating that question. He says, for debt levels to get so high, is there too much savings and investment? No, because I'm just thinking, guys, of a way that I can, this is a really great question. It's so hard to explain this without the whiteboard. Tom, the bottom line is most banks create the money supply through the issuance of debt. So there isn't necessarily a need for savings to issue debt and increase the money supply. So there's not a causation there. There might be a slight correlation, but now don't get me wrong, savings matters, and that's the way that you grow an economy, is by producing more than you consume. But that would be a savings vehicle that was non-bank related. So let's say a private equity fund or an angel fund. A bank, again, this is really hard to explain without the whiteboard, but the bottom line is banks don't necessarily need savings to create debt. So debt levels can get extremely high without any correlation to savings or investment. And by the way, Tom, I'm doing a video on that because that's a really good question. And so keep an eye out for that video, and that'll explain things in great detail. Okay, Clip Critics asks, would you buy rental now or wait for the market to fall? I would buy a rental property now, understanding that all rental properties are not created equal. Why is that? Because one of the main reasons you're buying a rental property now is because the rental property comes along with the only thing in the United States, or the only thing denominated in US dollars that's cheap. That's a 30-year fixed rate mortgage. So we got to start with what's cheap. So we know that the mortgage is cheap. How do we express that bet? Well, the only way to do it is by buying a really solid cash flowing rental property. Okay, now I see that you're in California. So no, now's not a good time to buy. Forget it. Forget it. Forget it. Forget it. Forget everything I just said. No, but seriously, it does apply. But what I would do is I would, instead of buying in California, I would just buy in a linear market like Little Rock or Kansas City. And then I would just rent in California. Why? Because the RV ratios are so skewed in your favor by owning in a linear market. And for further clarification, make sure that you watch that video that I did on, it's called Rent or Buy. I probably did it a month ago or so, but that'll explain it a lot better. But the main thing that you got, the way that you have to think of it is the only thing right now that you can own in USD that's cheap is a fixed 30-year fixed rate mortgage. So how do you do that with as little downside as possible? You buy that real estate asset under the cost of construction, hopefully, if you can do it, and in a market where the price to income ratio isn't just completely out of whack like it is everywhere in California. Oh, now you're asking about Florida. You're just going to have to, I don't know Florida that well. There may be pockets in Florida that could offer some opportunity, but I would start with looking at the RV ratio, and then I would try to find the data for that specific market to look at the price to income level. Spencer, that's a great question. I just saw that question. Let me see if I can stop this. Spencer asked, what type of REITs avoid the real estate bubble crash? None. I know REITs are really popular and I can see why, but I would definitely avoid commercial. I'd try to do apartments if I could. I just don't like REITs that much because they're a lot more tied to the stock market than an actual rental property is. And I like being in control of the asset that I own, if possible. And you just don't have any control of that REIT. And with a REIT, you're not able to leverage fixed rate debt. You're not able to leverage the only thing that's cheap with the 30-year mortgage. Okay, this is actually a really good question. So Ukmar asks, how many hours a day do you watch YouTube videos on the economy? That's a great question. Any opposing views, bullish to yours that you think may have merit? Yeah, I do. If you look at Brent Johnson's theory on capital flight coming into the United States because of the interest rate differential with the other major economies, I think that has a lot of merit. Obviously, with Jeff Snyder's view, I think that has a lot of merit, although he's not really talking about the market, more so the United States dollar. But one thing that I've never talked about that's really interesting and I'm sure a lot of you guys watching right now have the belief that I do that the inflation rate in the United States is a lot higher than they would let you believe through the CPI. If that's the case, if you look at a long-term chart of, let's say, housing adjusted for inflation, well, housing prices in real terms might not be as high as they actually are, because you're reducing the price more because the inflation rate in reality is a lot higher. So assets could be cheaper than we think they are when you adjust for inflation. Here's the problem. If asset prices are lower adjusted for inflation because we haven't been using the right inflation rate, so are wages. If you look at a chart of wages of the middle class, you'll see that since the 1970s, real wages, meaning wages adjusted for inflation, have been almost flat. Well, if we're now saying that the CPI is cooked and those wages should be lower in real terms, now all of a sudden, instead of having wages flat, now they're in a decline. So, especially with housing, I would say that even if the prices aren't as high as the current charts would lead you to believe, it's just as bad because wages are equally low. Hopefully that makes sense. Okay, let me try. I'm going to do a couple more questions here, guys, and I'm going to go grab some dinner. Oh, I got a lot of questions. Let me try to stop one. Oh, stop. I wish you could pause this thing. Okay, Muzardon on my feet. When dividend yield is higher than average, stocks are underpriced. When dividend yield is lower than average, stocks are undervalued. Thoughts? Apparently, way to see stocks worth look at that's easy. I agree. Absolutely. Because what are you buying when you're buying a stock? You're buying future cash flows. So if you're buying those future cash flows at a lower price, implying that the current dividend yield is higher, then yeah, it's cheap. So I would combine that with the CAPE ratio, with Buffett's gauge that he does. And that's the market cap ratio, the market cap to GDP ratio. And if you guys didn't see my video on that, make sure that you check that out. That I think it's Warren Buffett on the title, or that was the keyword, Warren Buffett. But you'll see that going back to the 70s and throughout the 80s, I think even into the 90s, the total market cap was like 50, maybe 55% of GDP. Now it's over 150%. That means that the market has grown, or financial engineering, or the financial economy has grown at a much, much higher rate than the actual real economy. And at the end of the day, what should stocks be driven by? That's the real economy. So it's way, way out of whack right now. Okay, let me do a couple more questions here. Let me try to go to the bottom. Okay, I'm trying to read these. I'm sorry for the long pause, guys. I'm just trying to do my best to get a question to stop. Okay, we got. Let's see. Let's go. Let's D. Okay, I've got your question right here. Stop D. George, I'm in California. My rental has a fixed rate of 4.8, paid for 7 years ago. Great, awesome. A new refi would give me 4.2 with a 30-year fixed. Should I do it or not? I don't think so, because if you look at how I did the math on this for someone the other day, because they front load so much interest on that, I don't know that it would be worth it to, when you're only gaining 60 basis points roughly. I don't think I would. I think what I would do is I would try to extract some equity, because I'm sure you got a ton of equity if you bought 7 years ago. And I would try to use that as a down payment on another 30-year to buy a rental property in the Midwest. So you're extracting risky equity and replacing it with less risky equity and more cash flow, while at the same time taking on more 30-year debt, which is extending the time that you have to short the dollar. Hopefully that makes sense. It's so much easier with a whiteboard, guys. Okay, I'll do one more question. We're going to take off here. Sebastian's yelling at me. Oh boy, I just can't get these things to stop. Sorry, guys. We'll have this handled next week. Okay, this will be the last question here. Remco asks, after watching your inflation deflation vids, why will the Fed not get in between both of those doom scenarios and keep printing enough money to hold the 2% inflation rate? It's because, Remco, the economy is not a thermometer. The Fed and the central planners, they like to think that they can just, it's just like a thermometer in your house where 71, it's a little too warm. I'm gonna just dial it down to 70 or 69. It doesn't work that way. What happens is they're going to try, or what most likely will happen, I think, is they're going to try to continue to hit that 2% inflation rate average. Keep in mind, they'll let it run hot. That's why they're trying to move this verbiage from a 2% target rate to a 2% average in target rate, because they know that inflation benefits the largest debtor of all time, which is the US government. So they let it run hot, but it can only run so hot before the bond market starts calling their bluff and raising long-term interest rates, or demanding a higher rate of return for the additional currency risk. So at the end of the day, it goes back to what I was saying at the beginning, where the markets are far more powerful than the Fed or any political party or country. And that if that inflation genie gets out of the bottle, you just can't, it's very, very difficult to get it back in. And it turns into a situation like we had in the 70s. I mean, that's the best example I can give you, Remco. If it was that easy to just turn in the dial, why didn't we do that in the 70s? Why? Because we couldn't raise inflation rates, or excuse me, we couldn't raise interest rates without crushing the economy. And finally, you got someone in there that had the balls to crush the economy. That's what it boils down to. By jacking rates up to 20%, the Fed funds rate went up to 20%. And that was, I mean, there were pitchforks in the streets. And Volcker, that there's just no one with the political huevos right now to pull that off. So inflation goes to the moon and they lose control of the whole thing. All right, guys, hour 45 minutes. Awesome. We still have almost 500 people here. Really appreciate it. Tomorrow's video, I don't know if I'm going to tease. Oh, yeah, I will tease tomorrow's video. Most likely going to be Jason Hartman, the first of our series on real estate investing. This guy is the quintessential pro. He is the best in the business, and I cannot wait for you guys to see this interview. And make sure you get in the comments and let me know what you think, because if you guys like these types of interviews that I do with professionals, I'll definitely do them in the future and incorporate them into the normal whiteboard videos that I do. Make sure I've got all the super chats here. I think I do. And thank you again, guys, for those super chats. And I will see you guys on the next video. That'll be tomorrow. Bye, guys.